Assalamu alaikum warahmatullahi wabarakatuh. We are grouped with the topic trends in money supply, household, and corporate debt. So we chose three countries to do our project on, which are Malaysia, China, and India. So basically, we're gonna discuss throughout the presentation what the trends of money supply and interest rates, the causes of its fluctuations, and the household and corporate debt among these countries. Now, these are the group members. So before we get into the relationship between money supply and interest rate, let me tell you what money supply is. Money supply is the total amount of currency and other liquid instrument, circulated in the economy. The indicator represents the broad money that include currency outside banks, demand time, saving, and foreign currency deposits of resident sectors other than the central government. So, what is the relationship between money supply and interest rate? Basically, a larger money supply reduces the interest rate, making it cheap or less expensive for consumers to borrow. Conversely, smaller money supply tend to raise market interest rate, making it pricier or expensive for consumers to take out a loan. Now, for household and corporate debts are measured as shares of gross domestic product. Household debt is defined as all liabilities of households, including non-profit institutions serving households, that require payments of interest or principal by household to the creditors at a fixed rate in the future. Trends of money supply in Malaysia. So you here, economists, or when we talk about money supply, we usually, mention M1, M2, and M3. Now, what are they? M1, M2, and M3 are measurements of the US money supply known as the money aggregates. M1 includes money in circulation plus checkable deposits in banks. M2 includes M1 plus saving deposits. M3 includes M2 plus time deposits in bank. Now for Malaysia, I will basically talk about M3 and M2. As you can see on the graph, for M3, there is a slight decrease between 2.2 million and 2.4 million. You can see it's, from low and then it increases, kind of like a stable bit, but then it increases and fluctuates. So all this fluctuation, basically I will talk as we proceed throughout the presentation. So for M2, it's the same as well. There was a slight decrease between 485K and 490K. So as we go, I will explain why these fluctuations occur. So according to the graph, for M3, the money supply in Malaysia decreased to 2,036,415.85 in October from 2,038,661.2 in September. As for M2, it was reported at 489.22 US billion dollars in October 2020. This record is an increase from the previous number for September 2020. This money supply is updated monthly, averaging 68.08 USD billion dollars from December 1969 to October 2020, with 611 observations. Now, why do these fluctuations occur? Now, bear in mind that money supply changes interest rate. So that's what we're gonna look at next. So interest rate is basically the cost of borrowing money. It's okay, like say it's a compensation for the lenders. Without that, a financial institution will not be able to lend money and borrowers will not be able to save money. So according to the graph, this is for Malaysia. Malaysia holds rates at record low of 1.75%. It was the highest in 2007, which was at 3.5%. However, it decreased all the way down and then it came up quite a little bit of stability, but it keeps on fluctuating. Till currently it's at 1.75%. So for next, we're going to see what causes these fluctuations. So the causes of these fluctuations, basically there are three main causes: monetary policy, inflation, and the supply and demand. So as we all know, when it comes to money supply, the central bank, for example, in Malaysia, it's the Bank Negara Malaysia. always plays an important role in this section. So, for the causes of the fluctuation, for monetary policy, the Bank Negagara left its key overnight policy rate unchanged at 1.75% on November 3, 2020. The central bank said the current monetary policy stance remain accommodative given the outlook for growth and inflation. And then the second one is inflation. Inflation and interest rate are closely linked. For example, according to the graph, the one I previously showed, the interest rate was 5.43%. It was the highest in 2008, and so was the interest rate, which was 3.5, but currently dropped to negative 1.13, which is deflation, with interest rate at 1.75%. Our economy is a living, breathing, interconnected system, and interest rates play a big role within it. Now, for Malaysia, as you can see on the graph, between 2006 and 9, there were more money supply. Now, what did the government do? So the government or the central bank, they implement expansionary interest rate or expansionary monetary policy. This policy reduces interest rate, thus boosts the economic growth. However, in 2010 or between 2009 and 10, there were less money supply. So when this occurs, the government then implements contractionary monetary policy. Now, this policy reduces money supply in the economy to prevent excessive speculations and unsustainable capital investment. So, contractionary monetary policy and expansionary monetary policy, these policies are used to, are used by the government or the central bank to cater and alter the fluctuations in the interest rate, thus, the money supply, because money supply always changes the interest rate.
Assalamu alaikum, I'm Omar Breka with metric number 1829657. In this part, I will talk about the household debt in Malaysia, and we'll go through a background on household debt, and we'll know the trends of household debt in Malaysia, and some of the vulnerabilities and strong financial position of household debt. So firstly, let's start with a background on household debt in Malaysia. Over the past 2 decades, Malaysian household debt, both in absolute terms and as a share of GDP, has generally been on a rising trend. Since 1997, the level of household debt has increased more than sevenfold, registering on average a double-digit growth of 11 per annum to reach 1.1 trillion in the first of 2006. Correspondingly, household debt doubled from 43% of GDP in 1997 to 89% of GDP in the first half of 2016, with the persistent increase in leading to the household sector. Households credit now accounts for more than 60% total bank and non-bank leading, surprising corporate credit since 2004. So household decision to accumulate debt can be ascribed to several factors. The three key factors that underpin the increase in Malaysian household debt are: first one is the macroeconomic stability, with sustained economic growth contributing to raising household incomes. Second one is financial sector development, promoting financial inclusion. Third one is government policies, promoting home ownership and the development of housing market. Beyond these factors, housing as a whole is crucial in understanding the accumulation of household debt. As experienced in other countries, raising household debt indebtedness in the past decade has often been tied to the development in the housing market 2016. Similarly, the increase in house debt in Malaysia over this period stemmed mainly housing credit. The stock housing credit as a share of GDP has constantly been higher than that consumption credit and has increased by about 20%, as you can see in graph 2, increased about 20 percentage points from 1997 to the first half of 2016. In level term, housing credit extended on average by 11% annum on account for more than 50 household debt in the first half of 2006. In contrast, consumption credit as a share of GDP only increased by 8 percentage points and constituted about 35% of household debt in the first half of 2006. So now let's talk about the trends of household debt or level and growth rate of household debt. Prior to the 1997 Asian financial crisis, the share of household credit in total outstanding bank loans was relatively small compared to the share of loans extended to business. At end of 1997, lending to the corporate sector accounted for 67% of total loans outstanding, but consumer financing has extended considerably as described in paragraph 1 from 2000 onward. The average annual growth rate for the period 2001 to 2007 was 40.8% as described in graph 2. After 6 years of rapid growth, household debt grew at the more moderate pace of 7.9% in 2007, in line with the more subdued housing and automotive markets. As at its end of 2007, household credit and now accounted for 56% of total outstanding bank loans. The financial vulnerabilities and household debt. As the result of heavy borrowing by Malaysian households, as it shown in graph 5, the ratio of household debt to GDP grew to 67% in 2007 from 47% in 2000. As with most forms of credit, the rapid development of household debt can create vulnerabilities, in particular if the debt reaches an unsustainable level. However, the level of household indebtedness in Malaysia, which is comparable to that of other countries in the region, remains manageable. Strong financial position of household debt. Malaysia household sector has demonstrated a great capacity to withstand shocks. In particular, net growth and income have grown broadly in tandem, supported by stable employment levels and a favorable economic environment. While their debt has grown rapidly, households have also accumulated sizable financial assets, as it's shown in graph 6. Since 2002, financial assets would remain relatively stable and more than double household debt have provided households with the flexibility to adjust the change in the economic environment.
Okay, Assalamualaikum warahmatullahi wabarakatuh. My name is Zaki Abdul Mahdi, my metric 1212425. So I'm from section 1 in macroeconomic with Prof. Nizam. So I would like to continue our presentation before. So let's move to the trend of money supply and interest rate in India country. So here we can see the money supply in India increased in the whole of type of money supply. So as we know that the money supply have three types, M1, M2, and M3. So here India reported that money supply increased in the whole of type. So let's move to graph. So we can see the Indian money supply was reported at around 500,000 USD in November 2020. This report an increase from the previous number of the October 2020. Indian money supply data is updated monthly, averaging around 41,000 USD from January 1957 to November 2020 with the 767 observation. So what the next? Let's move to prediction. So here India money supply in India is expected to be 18,176.40 INR billion by the end of this quarter, according to the Trending Economic Global Macro Model and Analysis Expectation. Looking forward, we estimate money supply in India to stand at 177,379.37 in 12-month time. In the long term, India money supply is projected to trend around 176,503.40 ENR billion in 2021. So that's all the report from the money supply in India. So let's move to Indian interest rate from 2000 until 2020. So the Reserve Bank of India kept its benchmark repurchase rate at 4% during its December meeting, saying it was maintaining an accommodative stance as long as necessary to support the economy hit by the COVID-19 crisis amid high inflationary pressures. So here, if you look in the graphs, the interest rate in India had declined rapidly during the 5+ period before that remained stable in 2020. So we can see that the data was inflection. So let's see the econom said, or let's see the prediction of econom. So here them said the interest rate in India is expected to be 4% by the end of this quarter, according to the Trending Economic Global Macro Model and the Analysis Expectation. Looking forward, we estimate, as the econom estimate, the interest rate in India to stand at 3.5 in the 12-month time. So I think that's all for me as the presenter in the money supply and interest rate in India countries. So let's move to Hadi. Thank you.
Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Khadija Ahmed, and here I will be discussing about the causes of fluctuations in India, the level of debt in India, and of course the corporate debt in India as well. So first of all, I would like to talk about the causes of fluctuations. So as we all know, in all the countries, they all have different causes of fluctuations, and every country differs from one another. But we might have a country that has the same causes of fluctuations. But for India, the causes of fluctuations here we have is increasing of labor costs. There are actually two. So the first one is increasing of labor costs, and the second one is increasing of raw materials costs. These are actually the two main causes of fluctuations in India. The next I have here is the level of household debt in India. At 43.5 trillion rupees by March, Indian household debt at high record. Indian household had debts worth nearly 43.5 trillion rupees at the end of March this year, which is 2020, up from 6.6 trillion rupees at the end of March 2008 and 19.3 trillion rupees 5 years ago. Household debts in India increased to 13% of the GDP in the second quarter of 2020 from 12.60% of GDP in the first quarter of 2020. The rise in household debt not only impacts net financial savings but also affects consumptions in the long run as disposable income eventually gets depleted. In fact, there is a cascading effect when a household starts cutting down on discretionary spending. The debt level can move up rapidly if Indian youth start spending like their Western counterparts. The demographics are favorable as more youngsters are joining the workforce every day. And unlike the previous generations of careful savers, they are not credit averse, Savings, investments, and spending patterns change whenever a new generation comes in. As we can see here, as we can look into this graph, you can see that January 2018, the percentage was almost getting to 11.5, and as of January 2019, the percentage was getting almost to 12%, and as of January 2020, it was at 13%. So this is basically the graph of the household debt in India from January 2018 to January 2020. So coming to the corporate debt in India, India's corporate debt, including bank loans, stands at 56% of the gross domestic product, which is GDP. A large part of this debt has turned risky in the last decade. At least 10.5 to trillion rupees worth of corporate loans and around 16% of the system level corporate debt is likely to default over the next 3 years due to prolonged shutdown in the economy. The GDP growth slowed down to a nearly 7-year low of 4.7% in October to December 2019. Most companies need to borrow money to set up a business, run the day-to-day operations, and execute new projects. This is why debt is crucial for a company's survival. However, too much loan can be very problematic. The interest the company pays on the debt can become too costly and eats into profit. It can even lead to a company's downfall. This is why investors keep a close eye on their company's debt levels. The debt market is one of the most critical components of the financial system of any economy and acts as a leverage tool in the financial system. The debt market comprises two segments. The first one we have is the government securities market and corporate debt market. Indian debt market is dominated by government securities as compared to corporate debt securities. Indian corporate bond market is very underdeveloped and illiquid in comparison with the government securities market. So this is all from me. Thank you for watching.
Assalamualaikum. I'm Sumar. Today I'm talking about level of household and corporate debts in China. Chinese households have been among the world's best saver until recently. In only 5 years, household debts has surged to 128% of household income and 56% of Chinese GDP. Over the past 5 years of 2015 to 2019, Chinese household has added $4.6 trillion in borrowing compared to a $5.1 trillion expansion in US household debts from 2003 to 2008. So, what a difference 5 years makes. From the end of 2014 to 2019, Chinese corporates added admission $5.5 trillion, but Chinese households joined in the party for the first time, adding $4.6 trillion in debts from banks loan. The surge in Chinese household borrowing are comparable in size to the run-up in US household debts in advance of the global financial crisis. So now we can see Chinese household debts from 2005 to 2019. Some expansion in household borrowing was therefore predictable as households have historically been underbanked in China. When the system favors state-owned corporates, the imbalanced structure of the Chinese economy is a key source of financial system risks. Household incomes makes up a far similar proportion of Chinese economy than in a more developed one. They are estimated at only 43% of GDP in 2019, a proportion that has remained relatively stable throughout the past decades. As a result, even though the aggregate level of household debts China is only a bit over half of US level. The debt level is now similar in size to the pre-crisis United States level as a proportion of household income. There is no magical threshold of danger in household debt to income ratio. Those in other developed economies are higher and likely sustainable. But as the second largest economy in the world, the absolute level of debt incurred in China are already quite large. Throughout the past decades, Chinese households have outpaced their American counterparts in adding new incremental borrowing in absolute US dollar terms every year since 2009. Now, the question is how and why did Chinese households debt so quickly? We would argue that four factors were involved which are critical to understand how household debt growth might change in the future. First, because of slowing economic growth in 2014 and 2015, Chinese leaders directly and indirectly encouraged household borrowing. The sharp slowdown in Chinese property sector and the deflationary forces gripping Chinese industrial sector in 2014 and 2015 left the government with few options. Second, the still buoyant property market facilitated and then required a rapid expansion in household borrowing. Most of Chinese expansion in household debt in recent years has been mortgage debt, which the PBOC places at $4.3 trillion as of the end of 2019, up from 11.5 trillion yuan at end of 2014. Thirdly, the deleveraging campaign launches in late 2016 redirected banks' incentive to lend to households rather than corporates. Fourthly, online payment platforms and new financial technologies created new mechanisms for households to engage with the financial system and borrow from both banks and non-banks intermediaries.
Assalamualaikum, my name is Mina. Today I will present it about trends of money supply and interest rate and causes of inflation in China. Money supply in a very long period of time is the People's Bank of China to perform the macro monetary policy to achieve macroeconomic goals, important intermediary variables. Money supply and gross national product, GNP, GDP, China's CPI, lending and deposit rates, the RMB exchange rate and asset prices and other major economic and financial indicators are more closely linked. As can be seen from figure, in 1990 to 2017, M0 is cash in circulation, M1 is narrow money, M2 is broad money. China's money supply, M0, M1, and M2 all showed a recent trend by year. With the development of China's economic and increasing improvement of people's living standard, people's total demand for money supply gradually expanded. The normal operation of China's economy is inseparable from the implementation and regulation of monetary and fiscal policies. According to the data, China's interest rate reached 4.35% in July 2019. Now we are move on case of fluctuation. Central banking system. The regulation of money supply is realized mainly through the general policy tools, namely the adjustment of the central reserve policy, the rediscount policy, the open market operations 3 policy tools, and the direct credit control, indirect credit guidance, and the other selective monetary policy tools. Fiscal system. The government stimulates social aggregate demand through fiscal expenditure such as economic construction and option fiscal revenue through taxation, income from state-owned asset and national debt. Commercial banking system. Through the implementation of credit policies and the regulation of deposit and loan interest rate, it influences the financing, deposit and loan behaviors of enterprises, institutions, and residents, thus affecting the flow of funds and the change of money supply. Financial markets. On the one hand, the emergence of financial markets and financial commodities has accelerated the flow, rates, and utilization in financing of funds and absorb a large number of social idle funds. On the other hand, it regulates the money supply structure by buying and selling stocks, bonds, notes, and other credit exchange instructions. Balance of payment, as can be seen from the balance sheet of the central bank, with the change from the compulsory foreign exchange settlement and sale system to the voluntary foreign exchange settlement and sale system in China. The foreign exchange reserve decreases year by year, but still accounts for a high proportion, and the central bank is always the largest reserve for foreign exchange.